Welcome to this, the intelligence stack.
It sounds a little ominous, doesn't it?
It does, but let's be honest, we're in a pretty ominous moment. It is February 2026. And if you've been watching the financial news, you know the ghost of 2008 is making a comeback. The Big Short is back.
That's right. Michael Burry, the guy who famously bet against the housing market. You know, the one Christian Bale played in the movie.
The one drumming in his basement while the world was on fire.
That's the one. And he's back at it.
And he is not playing small here. His last filings from late 2025 showed a massive position. We're talking over $1 billion in put options.
Against the absolute titans of this industry, Nvidia and Palantir.
And we should probably be clear about what a put option is for anyone who isn't a derivatives trader.
Yeah, this isn't just selling a stock because you think it might dip.
No, this is aggressive. A put option gains value when the price drops, but it has an expiration date. It's a melting ice cube. Every single day the stock doesn't crash, Burry is losing money.
He's effectively paying for the right to hold that bet. It's a huge, high-conviction wager that the AI industry is about to collapse.
And not just collapse eventually, but collapse now.
Exactly. He's putting his reputation and $1 billion on the line. And, you know, looking at the sentiment out there, he's not totally alone.
No, the bear thesis is pretty clean, pretty logical. It basically boils down to this. We are spending way, way too much money on things that don't make nearly enough money.
That's the CapEx conundrum. The industry's spending, what, roughly $400 billion a year on infrastructure?
Chips, data centers, cooling, grid upgrades, all of it.
And that's projected to hit $3 trillion over the next 5 years.
$3 trillion. That's a GDP-sized number. You're basically pouring the entire economy of the UK into silicon and concrete.
You are. And the bears look at that massive spend, and then they look at the revenue coming in. I mean, OpenAI, the biggest player, is maybe projecting $20 billion.
So compared to the capital going out, it's a rounding error. The bears just say, the math isn't mathing.
They're calling it dotcom 2.0,
Yeah.
Or the fiber-optic bust, you know, from the 2000s, where we laid all this dark fiber that nobody used for a decade.
The argument is we're building tulips with transistors, a bubble.
That is the prevailing narrative, that we're all standing on a cliff, and Michael Burry's just the first one brave enough to look down.
But this is where we need to pivot, because normally in a deep dive like this, we'd spend the next 15 minutes unpacking the crash, how the bubble pops.
Right.
But looking at the data, I think we need to ask a different question. There's a really dangerous assumption baked into that whole narrative.
The assumption is that the bubble pops.
Yes. But what if it doesn't? That's the question that keeps me up at night. What if the crash never happens?
What if Burry is wrong? What if the companies spending that $400 billion a year are actually right?
And that sounds like good news, right? Great. No recession. My portfolio is safe. But you're arguing that the success scenario is the one we should actually be terrified of.
Absolutely. Think about it. We have a playbook for failure. If the AI bubble bursts, we know exactly what happens.
The Fed cuts rates. Congress passes a stimulus package.
VCs write off their bad bets. We have this institutional muscle memory for crashes. We survived 2008. We survived the COVID crash.
We know how to clean up a mess.
Exactly. But we have zero muscle memory for this kind of success. If the bulls are right, we're heading for an intelligence infrastructure that makes the internet look like a dress rehearsal. And our economic systems, our tax codes, our labor markets, they're just not ready for it.
So we're so focused on the floor falling out, we're not seeing the ceiling coming down on top of us?
That's a perfect way to put it. We are prepping for a famine while standing in the path of a flood.
Okay, let's pressure test that. If we're going to argue this boom is real, we have to take on the bear case first. The dot-com comparison. Why is that lazy?
Well, I get why people make it. It's an easy pattern to match. Valuations feel high. The Magnificent Seven are dominating the market. VC funding is like 58% AI. It feels bubbly.
It feels very bubbly. But let's get into the actual numbers, because the difference between vibes and fundamentals is huge here.
Let's do a quick data blitz. Valuations. Back in 2000, at the peak, top tech firms like Cisco were trading at, 70 times earnings? A PE of 70?
70 times, meaning you'd have to wait 70 years for the company's profits to pay you back for the stock price.
It was pure fantasy. Today, the big AI players, Microsoft, Google, Amazon, are sitting around 26x to 30x.
Which is historically normal.
It's a little expensive, sure, But it's not insane. It's not a speculative frenzy where the numbers are totally detached from reality.
Okay, fine. So the stocks aren't as crazy. But what about the actual businesses? In 2000, you had Pets.com selling dog food at a loss.
Right. They were selling eyeballs. No clear path to profit. Today, just look at Amazon's AI personalization engine. That one feature alone drives an estimated $10 billion in revenue.
So in 2000, it was hope. Today, it's actual high-margin efficiency at scale.
Precisely. But the biggest difference, and this is what I think the bears really miss, is where the money is coming from.
The funding source. This is critical.
In 2000, it was all funded by debt, junk bonds, speculative IPOs. Companies were burning cash. They borrowed from, naive retail investors.
And when the sentiment turned, the money just vanished.
It did. But today, the ones writing the checks are the most profitable companies in history. Microsoft, Amazon, Google, Meta. They are printing money from cloud and ads and just reinvesting it. It's all cash.
Which changes the whole crash calculus. A debt bubble unwinds in a spiral. Everyone has to sell assets to pay back loans. Prices crash. More people default.
A domino effect. But here, there is no leverage spiral to unwind. If Google's AI doesn't pay off right away, they don't go bankrupt. They just have slightly lower quarterly earnings. They can keep spending for a very long time.
There was that one stat about Nvidia's receivables that really drove this home for me.
Yes, the smoking gun. In the dot-com era, you had this circular vendor financing. Telecoms like Cisco would literally lend money to their own customers.
So the customers could buy their equipment. It's basically accounting fraud to make it look like you have demand.
A total shell game. But Nvidia today, their receivables, the money they're owed, is only about 5 to 6% of sales.
Which means customers are paying cash up front before the chips even ship.
It's not fake demand. It is shut up and take my money demand.
Yeah.
The crash calculus assumes the money runs out. But these companies basically have infinite money glitches.
Okay, so the money won't run out. But what about the other argument, the glut? The idea that we're building too many chips and supply will eventually crush demand.
Right, which brings us to the DeepSeek event.
January 2025. I remember the panic. It felt like the whole narrative flipped overnight.
It was this fascinating psychological moment. A Chinese lab, DeepSeek, releases a new model and is performing at a frontier level, basically as good as the top models from OpenAI.
But the kicker was the cost. They trained it for, what, $6 million?
$6 million, compared to 60 or 100 million for everyone else. It was an order of magnitude cheaper, and it used way fewer GPUs.
And the market freaked out. The logic was, if AI is getting this cheap to build, nobody needs to buy expensive chips anymore. The boom is over.
It was a knee-jerk reaction, and it was totally wrong. It ignores a basic economic concept called the Jevons paradox.
The Jevons paradox. It's one of those counterintuitive ideas that explains so much.
It goes back to the 19th century and steam engines. An economist, William Jevons, noticed something weird. When steam engines got more efficient, they used less coal to do the same amount of work.
So you think coal consumption would go down?
Logically, yes. But the opposite happened. Coal consumption exploded. Because when energy got cheaper, it suddenly became viable to use steam engines for everything. Factories, trains, ships.
So efficiency didn't kill demand, it unlocked a tidal wave of new demand.
Exactly. And that is what is happening with AI. When the cost to train a model drops from $60 million to $6 million, you don't get fewer models. You get thousands of companies building their own models who could never afford to before.
So every bank, every hospital, every retailer suddenly wants their own specialized intelligence.
And that's what we saw.
Yeah.
The big tech CEOs didn't cut spending after DeepSeek, they increased it. Demand went nonlinear. The bear case is that supply outpaces demand, but the reality is demand is devouring supply before it even exists.
Okay, so let's assume the bulls are right. Burry loses his bet. The infrastructure gets built, it gets used, the economy transforms. This brings us to the really scary part, the tax bomb.
This is the issue no one is talking about. And you could argue it's the single biggest risk to our society over the next decade.
Lay it out for us. Why is all this economic success a problem for the government?
It's actually very simple. AI does not pay income tax.
And humans do.
And humans do. When you look at the federal budget, it's terrifying. In the U.S., something like 75% of all federal tax revenue comes from labor. That's payroll taxes plus personal income tax.
The whole system is built on the assumption that humans work, earn wages, and pay taxes on those wages.
And now Goldman Sachs estimates 300 million jobs are exposed to automation.
And exposed doesn't mean everyone gets fired tomorrow. It just means maybe wages stagnate or hiring slows.
Or a team of 10 becomes a team of 2, plus an AI. Whatever it is, if that labor tax base erodes, the government's funding model breaks.
And at the same time, the companies using the AI are becoming massively more profitable. McKinsey thinks there's like $2.9 trillion in value being unlocked.
But where does that money go? It goes to corporate margins, it goes to stock buybacks, it goes to capital gains for shareholders.
Which are all taxed at a much lower rate than wages. And crucially, they don't fund things like Social Security and Medicare.
So you end up in this bizarre scenario where GDP is skyrocketing, the country's getting richer on paper, but the government is going broke. We are running a 20th century tax code against a 21st century economy.
What about solutions? I remember Bill Gates talking about a robot tax.
He did, and the IMF basically shot it down. They argued you can't tax a robot, you can only tax the profit it generates.
But corporations are notoriously good at moving profits to low tax places. You can't move a factory worker to Ireland for tax purposes, but you can move an AI model there in a millisecond.
Exactly. We have no plan for a tax base that shrinks by 20% while the economy grows by $17 trillion.
And that growth. The speed is the other piece of this, the acceleration problem.
This is why the dot-com comparison is so misleading. The internet was a tool. AI is recursive.
Meaning it builds itself.
Yes. The internet didn't make it faster to build more internet. But AI is actively being used to accelerate AI research.
Like Google DeepMind using AI to design their next generation of chips.
Or Meta using AI to optimize training. Compute capacity is now doubling every 7 months.
7 months. Moore's Law was every 2 years.
It's autocatalytic. Each improvement makes the next one cheaper and faster. We are on a vertical path.
Which leads to these wild GDP forecasts. I've seen the Goldman Sachs one, a 7% global boost. That's about $7 trillion.
That's their bullish case. McKinsey predicts up to $25.6 trillion.
25 trillion. It's hard to even comprehend that number.
It's like adding another China to the global economy. But here's the thing. Even the skeptics are predicting massive numbers.
Daron Acemoglu, the Nobel laureate, he's famously cautious on this stuff.
The most cautious voice in the room. Even he predicts a $1 trillion boost, which is the size of the entire Swiss economy.
So the bear case is we add a Switzerland to the world, and the bull case is we add a China.
Either way, the impact is civilizational in scale. Which brings us back to the start. The danger isn't that it fails. The danger is that it works.
We're worried about Michael Burry's put options when we should be worried that our whole society is funded by human labor.
And we are rapidly building a world where labor is no longer the primary driver of economic value.
The real risk isn't the bubble popping. We have the tools for that. We have zero muscle memory for a world where the line on the chart keeps going up and to the right.
But the humans aren't the ones driving the growth anymore.
A crisis of success.
It is. We're facing the largest productivity shock since electrification, and our policy leaders are still debating if it's all just hype.
It feels like we're on the beach, watching the tide go way out, arguing about it, while a tsunami is forming just over the horizon.
That's the image.
So I guess the takeaway for you, for the listener, is to stop thinking about this as just a stock market play. Stop asking if Nvidia is overvalued.
And start asking, what happens to my job, my taxes, my government, if this technology actually delivers on its promise?
Because if that money doesn't run out, we're heading into a future we have not planned for.
A future where the economy grows, but the mechanism we use to distribute that growth, jobs, and wages might be broken.
Well, on that cheery note.
I know. But it's better to see the wave coming.
It is. I want to leave you with one final thought to mull over. We spend so much time worrying about the sci-fi nightmare, Skynet, the machines waking up. But maybe the real nightmare is much more boring. What happens if the machines just get really good at their jobs, the stock market hits 100,000, and most of us are just stuck on the sidelines wondering who's going to pay for the roads?
The boredom apocalypse. I like it.
Something to think about. Thanks for listening to The Intelligence Stack. We'll see you in the next deep dive.
Take care.